France economy. Q2. Debt problem and high unemployment paints a picture of a large advanced economy struggling to reconcile an elevated debt burden with structural labor market slack. In this quarter, France showed modest growth but continued to suffer from joblessness and heavy public liabilities that limit policy flexibility. To frame the narrative, we draw on current data across 2024-2025 from trading economics and related sources, emphasizing GDP performance, unemployment, interest rates, inflation, and debt dynamics, all through the lens of Q2's structural tensions. Starting with GDP growth, France's economy expanded modestly in 2024, with the full-year growth rate close to 2.0%. In Q1 2025, growth remained tepid, and preliminary assessments suggest Q2 continued in that tone. Quarterly expansion in Q2 is estimated at roughly 0.4 to 0.5% over the preceding quarter, translating into about 1.8 to 2.0% year-on-year growth. That rate is positive but far below historical potential, indicating that output is advancing slowly, constrained by weak domestic demand, structural rigidities, and global headwinds. In short, growth is present but subdued, offering limited room to absorb labor. The labor market remains one of France's most enduring vulnerabilities. The unemployment rate stood at 7.5% as of mid-2025, a slight rise from Q1. Unemployment among youth is especially high at nearly 18%, and long-term unemployment remains a concern, indicating persistent structural impediments. The high jobless rate constrains consumption growth, dampens wage pressure, and reinforces weak confidence in labor markets. On interest rates, France's monetary policy is largely determined by the European Central Bank. As of Q2, the prevailing policy environment is relatively tight, with ECB rates around 2.15%, setting a floor for French borrowing costs. This environment gives limited support to private investment and job creation, particularly for small and medium enterprises sensitive to financing costs. Inflation has also played a constraining role. In mid-2025, France's inflation rate hovered around 2.4%, driven by higher food and energy costs. Core inflation shows stickiness, sustaining upward pressure on real wage expectations and cost burdens for firms. The inflation level erodes purchasing power, complicates real income growth, and narrows margins for businesses already under cost pressures. The most acute structural challenge is France's debt burden. In 2024, France recorded a government debt-to-GDP ratio of about 113%, one of the highest among advanced economies. In Q2 2025, sovereign debt in nominal terms reached $3,416.3 billion. The high debt level imposes heavy interest servicing costs, constrains fiscal flexibility, and raises borrowing spreads. With deficits running large, approximately 5.8% of GDP in 2024, the combination of high debt and persistent deficits magnifies the structural burden. This reduces the government's ability to deploy large counter-cyclical stimulus or pursue ambitious public investment without worsening the debt profile. When we integrate these indicators, the Q2 portrait becomes clearer. Growth of about 1.82% year-on-year, unemployment near 7.5%, interest rates anchored near 2.15%, inflation around 2.4%, and debt exceeding 113% of GDP. This mix illustrates how France is constrained on multiple fronts. Growth is not robust enough to meaningfully reduce joblessness, and the debt weight limits policy leverage to do so. Within the quarter, the composition of growth reveals further stress points. Private consumption grew weakly, as households confronted inflation and wage moderation. Investment was subdued, hampered by high interest rates and uncertainty. Exports offered some support, particularly in luxury goods, aerospace, and food sectors, but were insufficient to offset weak domestic demand fully. Labor market flows in Q2 reflect this tension. While some hiring occurred in sectors such as healthcare and IT, these gains were offset by weakness in manufacturing, construction, and retail. Youth entrants and graduates faced particular difficulty finding stable employment, reinforcing structural unemployment even as the economy grew. Interest costs weigh heavily on firms, especially smaller ones. With borrowing rates linked to ECB benchmarks plus country risk spreads, many businesses delayed expansion or hiring, acting as a brake on firm-level employment. Inflation's impact on real wages and consumer confidence also matters. With consumer prices rising near 2.4% and wage growth constrained, real purchasing power growth is limited. As a result, despite positive GDP growth, the transmission to job creation is dampened. Fiscal constraints are central. Because a large share of public revenue must service debt, policy flexibility is weak. France cannot easily run large deficits for job creation without risking a further debt spiral or loss of market confidence. Looking ahead beyond Q2, the outlook is mixed. If growth remains around the 2% level, unemployment may only decline slowly without structural reform. Debt pressures will intensify unless fiscal discipline improves. France faces a narrow path. Modest growth must be lifted by structural reforms, like labor market flexibility and training, and selective public investment that improves productivity without exacerbating debt. The risk is that high unemployment and high debt combine in a feedback loop. Weak growth prevents job creation, which worsens deficits, which drives debt, which constrains policy responses, which further slows growth. In conclusion, France economy Q2, debt problem and high unemployment is an apt description of the current macro regime. GDP growth is positive but restrained. Unemployment remains high and structurally embedded. Interest rates are limited in how much stimulus they can provide. Inflation absorbs real gains, and debt levels exceed 113% of GDP. The debt burden and persistent unemployment intersect to create a policy trap. Without decisive reform, France risks prolonged low growth, chronic unemployment, and escalating debt stress. Starting with GDP growth, France's economy expanded modestly in 2024, with the full-year growth rate close to 2.0%. In Q1 2025, growth remained tepid, and preliminary assessments suggest Q2 continued in that tone. Quarterly expansion in Q2 is estimated at roughly 0.4 to 0.5% over the preceding quarter, translating into about 1.8 to 2.0% year-on-year growth. That rate is positive, but far below historical potential, indicating that output is advancing slowly, constrained by weak domestic demand, structural rigidities, and global headwinds. In short, growth is present but subdued, offering limited room to absorb labor. The labor market remains one of France's most enduring vulnerabilities. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.